Let's now bring in Arise business analyst Bode Ososami to comment on the CBN's decision and remarks on Bureau de Change. Bode, glad to have you join us on Arise News, Newsnight on Arise News. The MPC meeting, they decided to retain parameters and changes to the Forex regime. We will discuss, of course, the fact that the Bureau de Change later on in the program. But tell us your take or takeaway from the briefing and what has changed, if any.
Well, thank you for having me on the show, Andy. The main change in the context, listening very carefully to, it was a much longer briefing than usual, but it was also packed. It was much more optimistic, the context, both from the global and domestic side, with upside revisions on global GDP growth based on latest IMF and World Bank forecasts. Also talking about inflation in the West rising, but most likely transitory, but with lingering risks related both to COVID and the uncertain inflation trajectory. On the domestic front, at the last MPC, the projected GDP growth for Nigeria was expected to reach 2.3%. Now the central bank projects broad improvement for the rest of the year. In 2021, growth could be as much as 3.45%. That's CBN estimates. The federal government estimate could be 3%, and for the IMF 2.5%. So clearly, it was a much more optimistic outlook, given, of course, the evidence that the purchasing managers indices are looking in the right direction, but of course still in contraction territory. Inflation, like we know, still high, but moving in the right direction, albeit slowly. And all this is giving the central bank more confidence that its intervention initiatives are working. Once supply improves, as indeed it will, we will most likely see a slump in inflation. Banks remain in great shape. Capital adequacy is above requirements, and non-performing loans ratio came down from 6.4% last year to 5.7% as of July, with aggregate credit slightly moderating. So it was odd, however, that the central bank did not mention the unemployment metric. The normal policy mandate of central banks is to foster economic conditions to achieve both stable prices and maximum sustainable employment. But in all, the central bank was delighted at the downward trend of inflation, with output growth trending up, and is holding parameters constant, noting that conditions are not right to tighten by raising rates given the still fragile growth, or to loosen given the impact of inflation. And the committee also encouraged the use of other administrative methods and tools to rein in inflation, and of course intensifying intervention mechanisms targeted at the appropriate sectors.
But I would like you to address the issue of whether the CBN as a regulator really has, systems in place to check the excesses of the BDCs and others like it. But let's address this issue first, the issue of lack of transparency in the exchange, the Forex market. People are asking, especially experts, they're asking for changes, to encourage more capital inflows. Now, looking at the announcement to stop licensing BDCs, do you think this will help for transparency?
Let's understand why capital is not coming in, and still somewhat oil-dependent economy from a foreign exchange perspective. Many see a very dire situation requiring cautious management. If you look at sub-Saharan Africa, Nigeria has the highest negative interest rate. That is, if you take the rates and adjust for inflation. Nigeria's real rate is minus 6.25. South Africa is minus 1.4. Kenya is plus 0.7. And Ghana is plus 5.7. That is taking inflation, taking the policy rate and reducing inflation from it. When you have negative interest rates, it implies that foreign investors earn lower returns on their investments on inflation-adjusted terms, which leads to lower demand for the domestic currency and pressure on value of the exchange rate. Of course, there are other reasons like ease of doing business, factors like security, bureaucracies, and analysts are calling for an end to persecution of investors in some cases and making the environment more attractive. Opacity can be problematic. especially in a paradigm when the central bank tends to administer rates rather than allow markets to do so. And analysts have repeatedly asked, why can't we have one single universal rate instead of many rates, CBN allocation rates, I&E window, parallel rates, government rates on transactions, and so on. And on BDCs, the move to ban sale of foreign exchange to BDCs does help transparency, no doubt. Putting 7.2 billion annually to banks to do what the BDCs will have been doing. Obviously, the banks are more transparent, and it may curb some of the round tripping and corruption. But Ngozi, arbitrage, round tripping happen because of multiple rates, because of the clampdown by the central bank on independent sources of FX, not because the BDCs are a rare breed of financial saboteurs. Things would have been much better if central bank had allowed free movement of non-export proceed FX in and out of the country. There are many who earn unencumbered foreign currencies but are reluctant to bring them in because of various CBN restrictions on utilization for importation, delayed approval of Form M, not valid for foreign exchange, transfer limitations, and so on. Irrespective of what CBN says, we know what is on the ground. If BDCs are allowed to source and sell freely, the black market and gap between CBN and non-CBN will manage itself. Central banks should focus on their own FX earnings and control and stop muscling the free funds. That is killing liquidity, which is resulting in desperate practices, which will simply transfer from BDCs to bank tellers with all the policing. We've seen it before. So there are two broad scenarios. We could say a scenario where the central bank ensures that the purchase of FX via the banks, which will now increase the stress-free, minimal documentation, ample supply, noting that the FX supply is still dependent on oil prices and quite vulnerable. And of course, this will end the BDC racket. With more FX supply to the I&E window, this could work. And the problem would be the emergence of a new parallel market. And of course, that will have to be watched. The other scenario is that the central bank has underestimated the scale of the gap between the FX supply from official sources and the demand, which, of course, is not going to kill the BDCs, but push them into the deeper underground black market, where they will thrive with astronomical rates as round tripping escalates. So you have to choose the scenario that you think we're going to have.
Okay, of course, which of course means that the central bank has to find a way, dig in, and be able to chase those who go on the ground if that happens, just like it happens anywhere when people are sent out of business and they want to do it in all the ways. All right, but how are the markets and stakeholders likely to receive these changes relating to the BDCs?
Well, on the ground, the BDCs are very difficult to trace because everyone with money wants to get a good margin. But administratively, I've heard reactions that this could have been done administratively to reduce the panic, maybe winding down allocations to BDCs, raising the bank's allocations, and so on. And of course, nothing stops the central bank from making an example of any of the defaulting fraudsters. So the immediate reaction I've seen is that of a temporary spike driven by panic. And of course, that will continue until liquidity significantly improves. But the real problem is the emergence of a new black market, which is where the BDCs will move to, which further will drag down the Naira. Asking everybody, Andy, to go to a designated teller at a bank to buy FX for the smallest of transactions could lead to a depreciation or speculation against the Naira. That's what some experts say. And the statement that anyone who can get FX should report the problem to the central bank. How many people look for FX? How many people will not be able to get it? This requires clarification in terms of practicality. So let me just say something. There is an opportunity, no doubt, and the central bank means well, but we have more administrative measures, and administrative measures, particularly where markets work better, always lead to more administrative measures, more rules, and more punishment, rather than plain admission that administrative measures do not typically work with markets that naturally seek freedom. So there's an opportunity if there is ample supply of liquidity to back this up. but it certainly will be a tough act for the central bank to maintain this policy and not cave in. And of course, there will be a lot of lobby from the BDCs to see this reversed, taking us back to square one.
Okay, Bode Ososami, a RISE business analyst there. Of course, the real concern is that the CBN is making this directive to take effect immediately. Thank you so much, Bode Ososami.